Picking the right stocks is important because it can significantly impact your investment returns. By choosing stocks that have the potential to grow exponentially in value, you can increase your chances of making a profit on your investment. Now, who doesn't want that? Needless to say, some stocks have better returns than others, so it's only natural that we want to invest in those. Hey, welcome to Stock Market Mate. Today we'll be diving into the top 7 stocks that have the potential to join the elite $1 trillion club. But before we start, do give us a like and subscribe to the channel to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Predicting what companies will have a market capitalization greater than $1 trillion in the future is difficult, as it requires a high degree of speculation and forecasting. However, we've narrowed it down for you. Number 7. Apple. Apple is currently one of the most valuable companies in the world, with a market capitalization already of around $2.2 trillion as of April 2023. It also has a history of generating strong financial results, with consistent revenue growth, high profit margins, and a large cash reserve. This financial strength can make the stock an attractive investment for many investors. On top of this, it's one of the most recognizable and valuable brands in the world, with a loyal customer base and a reputation for innovative and high-quality products. This can make the stock attractive to investors who believe in the power of the Apple brand. The stock also has a diverse product portfolio that includes iPhones, iPads, Macs, wearables, and services such as the App Store and Apple Music. This diversification can help to mitigate risk and make the stock attractive to investors who prefer a diversified investment portfolio. Moreover, Apple also has a history of returning value to shareholders through share buybacks and dividends, which can make the stock attractive to income-seeking investors. Overall, investors love Apple stock for its financial strength, brand recognition, diversified product portfolio, and shareholder-friendly policies. Number 6. Microsoft. Microsoft is a highly diversified corporation that holds a robust market position in various areas, such as operating systems, cloud computing, video games, productivity software, and social media platforms like LinkedIn. Additionally, the company is set to expand its digital advertising business by teaming up with Netflix this year. In the year 2022, Microsoft's varied sources of revenue exhibited their ability to withstand economic challenges. Certain business segments, which were less affected, were able to maintain growth in earnings despite the decline in specific markets. Despite a decrease of 22% in the stock's value in the previous year, its 157% growth in the last 5 years establishes it as a trustworthy investment choice for long-term investors. Artificial intelligence is an industry that is rapidly growing, and Microsoft appears to have positioned itself advantageously in this field. Investing in this tech giant could potentially yield significant returns over the long run as the AI market continues to evolve. Number 5. Alphabet. Additionally, Alphabet is a leader in the rapidly growing cloud computing industry through its Google Cloud platform. The company's strong financials, solid earnings growth, and commitment to innovation are also factors that make Alphabet stock an attractive investment option for many investors. Although the company experienced setbacks in 2022, its previous growth indicates that it is not likely to remain down for a prolonged period. In the last 5 years, the company's stock has gone up by 64%, and it has increased by 238% in the last decade. This remarkable growth can be attributed to a substantial surge in annual revenue, which has gone up by 106% to $282.8 billion since 2019. Along with a soaring operating income, which has gone up by 130% to $74.8 billion. 2022, and it is anticipated to grow at a compound annual rate of 14.1% until 2030. As a result, the business of Google Cloud is expected to continue growing for many years, particularly as the company places a greater emphasis on artificial intelligence. Number 4. Amazon. A stock market sell-off in 2022 has dragged down the shares of numerous companies, with Amazon stock down 50% year-to-date. However, despite macroeconomic headwinds, Amazon has continued to see growth within its e-commerce business over the last year. Amazon is a dominant player in e-commerce and cloud services, benefiting from competitive advantages in its size and scale, which allow for a vast selection of affordable goods for consumers. The shift towards e-commerce continues, with Amazon continually gaining market share despite its size. Its Prime program provides recurring high-margin revenue while offering customers exclusive content and one-day shipping. This leads to a mutually beneficial relationship between buyers and sellers, while devices like the Kindle help attract new customers and retain existing ones. Amazon Web Services positions the company as a leader in public cloud services. While recent belt-tightening measures and the closure of some Amazon Go stores may affect near-term growth, healthy long-term growth is still expected. Number 3. Tesla. A few years back, Tesla stock wouldn't have been considered a smart investment, but the past year has seen it drop by 64%, making it look like a more reasonable option when taking into account its potential earnings in the long term. Tesla has made significant strides since its financial troubles almost pushed it into bankruptcy over a decade ago, and it is now financially stable and profitable. As a result, the company's success is not solely reliant on the skill and perseverance of one individual. Tesla is outperforming its competitors in the automotive industry as it becomes a highly profitable machine. In Q3, the company's total revenue increased by 56% to $21.45 billion, while its net income doubled to $3.29 billion. Meanwhile, Toyota, its biggest rival, only earned $3.15 billion in the same period, despite selling 7 times more vehicles. According to Nikkei Asia, Tesla's competitive advantage lies in its strong brand, which enables it to charge a premium price for its cars. Number 2. Berkshire Hathaway. Berkshire Hathaway had a successful year with increased operating earnings, a significant increase in investment activity, and strong stock performance that outpaced the S&P 500. The company's prospects for 2023 are promising, with several factors contributing to potential growth, such as improved insurance profits, the acquisition of Allegheny in Q4 2022, higher yields on its substantial cash reserves, and income from 2022 equity investments led by Chevron and Occidental Petroleum. Over the past few decades, the average P/B ratio of Berkshire Hathaway shares has been 2.1. However, currently, the shares are trading at 1.7 times book value, which is almost 20% below their long-term average. Given that Berkshire is a strong and diversified company with quality businesses, its stock becomes even more attractive in this market environment. Investors who are seeking a high-quality blue-chip stock during a volatile market should consider Berkshire as one of their top options. Moreover, getting shares at a lower price than the long-term average is an added bonus. Number 1. Nvidia. In 2022, Nvidia's stock price decreased by 50% due to inflation worries and concerns about an impending economic downturn, causing consumers and businesses to cut back on technology purchases. However, despite the challenging economic conditions expected in the near future, Nvidia's future prospects remain promising. Nvidia is at the forefront of accelerated computing and specializes in producing powerful graphics processing units that can quickly process vast amounts of data. Additionally, Nvidia leverages its high-performance chips in conjunction with specialized software to further enhance the speed of various applications. This makes Nvidia a key player in the tech industry, providing computing systems that drive the most significant trends such as cloud computing, artificial intelligence, and the metaverse. Nvidia's leadership believes that the company has a vast market opportunity, estimated to be worth $1 trillion, due to its many potential applications. Despite generating $28.6 billion in revenue over the past year, the company has significant potential for long-term expansion. Moreover, John Petty research indicates that Nvidia holds an 88% share in the PC gaming market by providing high-end graphics cards. Nvidia's ray tracing technology is highly advanced and is widely used by developers and gamers, which increases the popularity of Nvidia's chips. As a result, any rise in the PC gaming market, which is predicted to occur in the near future based on long-term trends, should boost Nvidia's sales and profits. Well, that's about it for today's video. We hope you enjoyed the video about the top 7 stocks that could join the $1 trillion club. Let us know your thoughts in the comment section. If you found this video helpful, kindly click the like and subscribe button. Thank you for watching, and we'll see you at the next one.
If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!